Good morning, ladies and gentlemen, and welcome to the American Enterprise Institute. I am Arthur Brooks, president of AEI, and I'm honored and delighted to welcome you to this event featuring United States Secretary of the Treasury Jack Lew to speak on the U.S.-China economic relationship. Secretary Lew has had an incredible, distinguished career in public service. He was confirmed as the 76th Secretary of the Treasury after serving as the White House Chief of Staff for President Obama. Before that role, he was the Director of the Office of Management and Budget, a position he also held in the Clinton administration. The Secretary Lew is constantly wrestling with some pretty tough economic issues, and this is the toughest that we're currently facing. He's going to tell you about what he's finding, what we can expect, and we're looking forward to that. We're also looking forward to welcoming another friend of ours to the stage, Greg Ip. Greg is the chief economics commentator for the Wall Street Journal, where he writes about U.S. and global economic developments and policy in his weekly Capital Account column and on Real-Time Economics, which is the journal's economics blog. They're going to hold a conversation after the conclusion of Secretary Lew's remarks, and then we're going to open it up for audience questions. So with that, please join me in welcoming Secretary Jack Lew.
Well, thank you very much, Arthur, for that kind introduction, and thanks to AEI for hosting this morning. It's really a pleasure to be with all of you today to discuss the economic and financial relationship between the United States and China. It's one of the most consequential bilateral economic relationships in the world. It's a relationship with many dimensions, where serious differences on issues such as human rights exist alongside the reality of our deep and expanding economic ties and growing cooperation on global challenges such as climate change and disease eradication. It's also a relationship where opportunities in the economic sphere have long been closely tied to broader political and security considerations. And it's a relationship that continues to grow in importance as China navigates a challenging economic transition to a more balanced, sustainable economy that's rooted in domestic consumption, reductions in excess capacity, and greater openness. Both the United States and China recognize that the future of our two countries is increasingly interconnected. For our part, we want China to succeed in its economic transition because China's success benefits our own economy as well. We continue to welcome the emergence of a peaceful, stable, and prosperous China that plays a responsible role in global affairs. In my remarks today, I'd like to describe the Obama administration's approach to the U.S.-China economic relationship, the progress that we've made in key areas that will be central to our relationship moving forward. The United States and China are the two largest economies in the world. We account together for roughly 1/3 of total global output. And in recent years, our countries have been the primary engines of global economic growth. Just as China benefits when our economy does well, America benefits as a growing China becomes a larger market for our goods and services. U.S. exports to China have roughly doubled since 2009, substantially faster than in any other region of the world. As the world's second largest economy, disruptions in China can have negative consequences for the rest of the world, including here in the United States. Over the past year, China rattled global markets as exchange rate policy changes raised questions about how it would manage the transition to a more sustainable growth rate. And as China continues to grow, it's more important than ever that U.S. companies have the ability to compete on a level playing field, both within China and globally. We need to challenge China's policies when they disadvantage our firms and workers, whether they're currency practices, trade barriers, or excess capacity in industrial sectors. But our relationship is important beyond sheer market size and GDP. U.S. and Chinese leadership can be a catalyst to drive higher global standards and promote growth, fair trade, global development, and efforts to protect the environment. When our nations reach agreement, it becomes a magnet for others to join. Finally, a strong U.S.-China relationship has been integral to increasing the effectiveness of important tools like financial sanctions. Close cooperation was critical in implementing sanctions on Iran and continues to be essential in responding to North Korea's nuclear provocations. For this relationship to work, we need effective communication, both to seize opportunities and to directly address differences. The way in which the United States and China engage with one another on financial issues has been transformed over the past decade as we've worked more closely together. Economic dialogue has been part of the U.S.-China relationship since the 1970s, initially under the rubric of the U.S.-China Joint Economic Committee. China's accession to the World Trade Organization marked another critical milestone. But these dialogues were largely transactional, with official meetings frequently characterized by formal recitation of talking points. There was no ready mechanism to develop high-level relationships, escalate issues to leaders, and establish priorities for engagement to produce results. Former Treasury Secretary Hank Paulson changed this with the establishment of the Strategic Economic Dialogue in 2006. Recognizing the role that economic issues play within the broader bilateral relationship, the Obama administration expanded the discussions to create the U.S.-China Strategic and Economic Dialogue, or the S&ED, adding a foreign affairs track to complement the economic track. To ensure the S&ED would achieve concrete results, President Obama and President Xi Jinping designated China's Vice Premier Wang Yang and myself as special representatives with the responsibility of coordinating and bringing together all relevant agencies within our respective governments to expand economic priorities and to narrow differences. This important engagement has changed how we view each other and how our shared leadership role in the world works. By no means do we agree on all issues, but we continue to build trust by identifying areas of common interest and, as I said, managing our disagreements. And increasingly, we find ways to coordinate on important global priorities. Results are the best proof that this process has great value. Let me start with global priorities. To cooperate effectively, it's important to begin by acknowledging how much the world has changed over the past half-century. The Obama administration recognized early that the growing economic weight of major emerging markets makes it essential that they be included in and share responsibility for upholding and leading the global system. As emerging nations acquire more representation and a larger voice in international institutions, they also assume growing responsibility for living up to existing high standards and a role in strengthening those standards for the future. This idea is what animated the U.S. push to reform governance at the International Monetary Fund. At the outset of the administration, China was still wedded to the notion that advanced economies like the United States held responsibility for most global issues. But as China has grown and moved increasingly from a recipient to a provider of development assistance, it's become more willing to cooperate and contribute to addressing global challenges. On trade issues, we used the S&ED to finalize an agreement to expand the trade of information technology products. This required regular engagement, often at the highest levels of our respective governments. But together, we facilitated agreement among nearly 50 trading partners. The WTO Information Technology Agreement was the first major tariff elimination measure in the WTO in 18 years, a critical achievement for the United States, as information technology is one of our competitive strengths. And every year, we export more than $100 billion of made-in-America technology covered by the agreement. On climate change, we agreed on both meaningful goals and a shared perspective on how to achieve them. We were able to overcome concerns that those who make commitments and take steps to reduce greenhouse gas emissions would be at a disadvantage commercially compared to those who do not, but still benefit from the efforts of others. The progress we made began in 2013 when President Obama and President Xi reached an earlier agreement on hydrofluorocarbons, or HFCs, during their summit in Sunnylands, California, an agreement reached after preliminary conversations between S&ED special representatives, which helped lay the foundation for success at the 2015 Paris Climate Conference. Building on this momentum, we share the goal of bringing the Paris Agreement into force this year, and are working together for strong climate outcomes at the G20 Leaders Summit this fall. The United States and China have also both committed to conclude negotiations this fall on an HFC amendment to the Montreal Protocol and a market-based measure to reduce aviation emissions. We're working closely with China to craft measures that balance the interests of companies growing at different rates. And when China proposed a new multilateral development bank, the Asia Infrastructure Investment Bank, many also assumed that the United States would be opposed. In fact, from the start, our position recognized the need for additional investment in the region and the important role of multilateral mechanisms in financing it. It was also our view that new institutions must maintain high standards of governance, environmental and social safeguards, procurement, and debt sustainability. Today, the AIIB is much more likely to meet these standards as a result of our shared dialogue and our support for co-financing and cooperation with institutions like the World Bank and the Asia Development Bank. When President Obama and President Xi met last September, China affirmed its support for the existing international financial institutions, declaring that new institutions like the AIIB should operate in line with their high standards. President Xi also pledged to work with the United States to continue to reform and modernize the existing international financial institutions, while also agreeing to meaningfully increase China's role as a donor in these institutions. Our close dialogue was also critical in establishing the International Working Group on Export Credits in 2012, marking the first time that OECD and non-OECD countries, including China, have committed to negotiate a new set of guidelines to discipline government support of export finance. These guidelines will level the playing field for U.S. exporters and ensure that government support will complement rather than crowd out commercial export finance. We've also made significant progress on bilateral issues in recent years, often in areas that create tension between our two countries. We've not shied away from confronting sensitive issues that directly affect U.S. economic interests. When China issued regulations for information and communications technology equipment purchases by the banking sector, it raised significant concerns among U.S. banks, tech companies, and cyber policy experts alike. We pursued these issues aggressively at the S&ED through the relationships we had forged. We did the same when U.S. businesses raised concerns about the discriminatory application of a new anti-monopoly law. In response, China suspended its ICT rules for the banking sector and undertook specific commitments related to the application of its anti-monopoly law. And as part of President Xi's September 2015 state visit to the United States, we secured a commitment from China to limit the scope of its national security review of investments to true national security concerns, which would prevent an expansion to broader public interest or economic issues. China also made several other commitments, including a safe harbor for transactions that complete the national security review process, and a commitment not to use information from third parties for the purpose of promoting the commercial interests of competitors. While we've made progress, national security reviews remain an area of ongoing concern, and we expect China to implement these commitments, and we will remain vigilant in advancing U.S. interests in this respect. In recent years, China has committed to a variety of steps to open its economy and level the playing field to the American business community, including improved transparency on regulatory measures. But we continue to raise concerns about the general climate in China for U.S. businesses. When I was in China last week, I told Chinese leaders that I consistently hear from foreign firms and their concerns about new obstacles in China's laws and practices. And this is a concern China should want to address because they should want to attract U.S. investment and business activity. China has also made a number of important commitments with regard to intellectual property rights, including equitable treatment for foreign intellectual property and vigorous investigation and prosecution of trade secret theft. But more work remains to be done. A high-standard bilateral investment treaty would strengthen the climate for American businesses in China, but this remains a work in progress. During the 2013 S&ED, we reached the understanding that the BIT would cover all phases of investment and all sectors of the Chinese economy, subject to limited negotiated exceptions. Such an agreement could unlock new opportunities and level the playing field for U.S. firms and investors. This week in Washington, the U.S. and Chinese negotiating teams are discussing revised negative list proposals. A sufficiently ambitious negative list from China could open a pathway to additional progress before the end of the year. Not all of our discussions are easy, and we often use our dialogue to confront contentious issues head-on. It's no secret that cyber-enabled theft of intellectual property has been a point of friction between our countries in recent years. Our longstanding position is that governments should not engage in cyber-enabled economic espionage for commercial gain. We have since established consultation mechanisms to deepen coordination on a range of cyber issues, and they're generating steady progress. but they have not resolved all of our challenges in this area. We're watching very closely to ensure China's commitments are followed by actions, and we'll use all tools available to hold violators accountable. I saved for last one of the most complex issues, the exchange rate. For a decade, large-scale Chinese foreign currency intervention to prevent the RMB from appreciating was a major issue in our economic relationship. As China intervened, it was also building large current account surpluses, more than 10% of China's GDP in 2007. Over and over, our message to China was clear. Unbalanced export-dependent growth through an undervalued exchange rate and growing current account surplus was both unacceptable and unsustainable. We emphasized that it was a source of significant and growing friction between our two countries, and that it was broadly harmful to a stable and balanced global economy. A message we advanced not only bilaterally, but also through multilateral mechanisms like the G20 and the IMF. We also argued forcefully that a shift to a more flexible exchange rate was in China's own interest, as it would help rebalance China's economy away from the manufacturing-heavy export sector toward services and domestic demand. The undervalued RMB made imported consumer goods more expensive even as Chinese policymakers sought to promote greater consumption. This message was not always well received by our Chinese counterparts, but the issue remained front and center in every engagement. By virtue of this persistent focus, and through a succession of S&ED meetings and our work at the G20, we obtained progressively stronger commitments from China to allow more flexibility in the exchange rate and to adopt greater transparency regarding its foreign reserve holdings and to limit foreign exchange intervention as part of exchange rate reform. China allowed its exchange rate to appreciate against the dollar and the currencies of its trading partners. And it took other policy measures to rebalance growth towards domestic demand. As a result, China's current account surplus fell below 3% of GDP. Last August, China introduced an unexpected change in exchange rate policy that, when poorly communicated, caused the RMB to depreciate and led global markets to sell off sharply. The global concern reflected a fear that China's economy had weakened quickly and that policymakers were responding through an intentional devaluation. It was important, even in the dog days of August, to consult quickly and understand what China was really trying to accomplish, and our established relationship facilitated that process. What I heard from China's economic leaders was quite different from the prevalent interpretation in global markets. China's economic leaders said their move, in fact, was an effort to move to a more flexible, more market-oriented exchange rate, reflecting fluctuations against a global currency basket, not just the dollar. They saw the move as a step towards meeting both U.S. and IMF policy concerns. These conversations gave me the confidence in their intentions and actions. I believed I could speak publicly in a manner that would calm rather than amplify market concern. Ongoing channels of dialogue positioned us to provide advice on both policy and communications. We emphasized to China's top officials the urgent need to act to stabilize its markets and to communicate firmly that China had no intention to engage in competitive devaluation. I knew that our advice had been followed when I heard my Chinese interlocutors refer to the religion of repetition, the idea of being clear and consistent with message, and a concept I had repeatedly addressed with them. We've come a long way on exchange rate issues. Today, rather than intervening in foreign exchange markets to weaken the RMB, China has used its foreign exchange reserves over the past year to support the RMB amid fragile global conditions. But China still has work to do to achieve the goal of creating the conditions for an orderly transition to a market-determined exchange rate. At this month's S&ED, China committed to continue to advance those reforms, allowing for two-way flexibility in the exchange rate. China must demonstrate its actions, not just its words, its commitment to that two-way flexibility. It's one thing for China to allow the RMB to weaken when there are market pressures for it to depreciate. The real proof of China's commitment will be in its willingness to allow the RMB to strengthen when appreciation pressures reemerge. Any reversion to the foreign exchange policies and export-led growth model of the past within the current context of weak global growth would trigger a new round of tension between our two countries. I believe the future of the economic relationship between China and the United States will largely hinge on three interrelated questions. First, will China fully implement the ambitious economic reforms that it's announced in a way that decisively embraces the market, leads to greater openness, and produces sustainable growth? China's third-party plenum reforms seek to do just that. They set out a blueprint that, if implemented, would shift China's economy away from dependence on exports, investment, and heavy industry towards sustainable growth based on domestic household consumption. The reforms are premised on allowing market forces to shape the dynamics and allocation of resources in China's economy. These commitments were recently reaffirmed by the actions of the National People's Congress to move ahead with reform policies. China's success implementing these efforts is of great importance to the global economy, and how China's leaders balance economic analysis and hard political choices will be key to that success. Cutting the knot of excess capacity that's distorting global markets illustrates many of the challenges that China continues to face. As China faces new demographic pressure with a decline in labor force and a transition to a new normal of lower and more sustainable growth, demand for steel and other materials will simply not grow by anywhere near the rates forecast just a few years ago, and may in fact decline. As China's investment boom settles back to a more normal level, the country and the global economy are saddled with production capacity well in excess of total demand, leading to damaging distortions in international markets. Significant reductions in excess capacity in China, phasing in modern plants and phasing out old, inefficient, and dirty plants, must result in lower, not higher, capacity. This adjustment is necessary to bring about efficient use of resources, rebalance the Chinese economy, and eliminate unfair trade. It will also require hard choices, particularly given the Chinese leadership's long-standing concern for stability and the employment consequences of reducing production and shutting down plants. But in dealing with excess capacity, it's not simply a matter of shutting down facilities. In addition to reducing current capacity, China also needs to address the factors that fed the construction of excess plant and equipment. These include subsidized credit, particularly for state-owned enterprises, an inclination to turn to investment whenever growth falters. China provides strong incentives for provincial and local leaders to build local industrial facilities without taking industrial capacity into account. We've encouraged China to develop a broader basket of fiscal tools, including more demand-oriented policies that would support the transition to a more consumer-driven economy. At last week's S&ED, China committed to address many of these market distortions and to progressively reduce excess capacity in the steel sector. Financial sector reform, the choice of fiscal measures that support rebalancing, and provincial and local fiscal reforms that tighten budget constraints will be key to solving excess capacity in China's broader reform agenda. I believe that China's economic policy leaders understand what needs to be done and realize that these reforms cannot be delayed indefinitely. But they need to be prioritized to avoid major economic dislocations and to place China firmly on a path towards sustainable growth. The second question to be answered is, will China view foreign business as a partner in advancing its economic development? Deng Xiaoping and subsequent generations of China's leadership recognized the potent role that foreign trade and foreign investment could play in transforming China's economy. Recently, however, there's been a growing sense among foreign businesses that they may no longer be welcome as new regulations and legal changes appear to specifically disadvantage foreign businesses. These concerns are not limited to U.S. businesses. In a business confidence survey released last week, the European Union Chamber of Commerce in China described a business environment that is increasingly hostile and a playing field that is perpetually tilted in favor of domestic enterprises. As they cited this as one reason for a fresh wave of pessimism among European companies. The report said that China had failed to deliver on promises that foreign investors in China will enjoy a more open, competitive market. We've used the S&ED as a platform to focus high-level discussions on addressing big challenges. But ultimately, it will be up to China whether to cultivate a business climate that fosters competition and invites participation by foreign firms. The willingness of China to engage in serious negotiations on a high-quality U.S.-China bilateral investment treaty will be one important barometer in this regard, as will China's future actions to address concerns about implementation of its national security review. My final question is, will China and the United States be able to collaborate productively on global governance? Signs are encouraging that China is ready to shoulder greater responsibility and contribute more resources to address global trade development, and climate change challenges. China has the opportunity to build upon the progress in the WTO on the Information Technology Agreement by showing leadership in advancing an environmental goods agreement. China has indicated that it intends to embed the high standards of the existing international financial institutions into the AIIB while working to continuously improve those standards. It's critical that China deliver on that promise. It's also critical that China be willing to embrace these standards on governance and transparency in its own initiatives, such as the One Belt, One Road, and its South-South Climate Cooperation Fund. This will be important in further establishing China's reputation as a contributor to responsible leadership on the global stage. The answers to these three questions are highly consequential for the strength of our two economies and the global economy, for the bilateral economic relationship, and by extension, for the bilateral political and security relationship that is so vitally important today. I'm convinced that the foundation that we've established, particularly the key forum provided by the S&ED for engaging China on these and other issues, will be critical to navigating these challenges in the months and years ahead. Few global relationships are as important as the one between the United States and China. And few global relationships today have evolved as far and hold as much promise. We understand that we have a tremendous stake in each other's success and that the consequences of our economic policies are significant not just for each of us, but for the global economy. I believe my Chinese counterparts would agree when I say I'm proud of the working relationships we have built over the years. It's essential that these relationships grow even stronger and the processes even deeper to tackle the significant work that lies ahead for generations to come. Thank you very much.
Thank you very much, Mr. Secretary. This was great remarks, a really good sort of summary of where we've come over the last few years. I want to start actually close to where you ended because you laid out an impressive list of things you've managed to accomplish with respect to improving relations on a commercial basis with the Chinese. But then you point out that businesses themselves feel things are getting worse. You cited a number of surveys that suggest they're finding it harder to do business in China. So what explains this dichotomy? Is it their imagination? Are things actually getting better? They just feel it that way? Or are things, in what respect are things actually getting worse, and why?
So, Greg, I actually think it's both. I think that we have made real progress. The specific steps that I described are all real. And I think it was very helpful over the last 3.5 years that I've been in this role, building confidence that the environment was getting better when we raised issues and they were resolved. But it's not as if you move only in one direction. New issues arise, and how those new issues are addressed is very significant. When you talk to Chinese officials, they tell you that it's not their intention to have the environment be hostile. They're looking to create a new order of rule of law, and if the laws aren't right, they'll fix them. The test will be, do they respond and do they fix them? If their intention is to have an environment that is truly welcoming, they'll listen to the concerns that I'm hearing and that we raise, and they'll address them. I think this is an ongoing process. I don't think that the comments that I've heard in recent months, I'd say the last 6 months, has been notably different than the year before, are a good sign, but it's not a final sign either. It's a warning sign. If China responds and addresses those concerns, I think China is a market that will remain very attractive. If they double down and make these restrictions such that a business has to say, is it worth the upfront investment because I'm not going to get to the finish line, they'll start to see interest slack off. And I was very clear with them that this is not just an issue that we think is in the U.S. interest, it's very much in China's interest. They need the innovation that comes from foreign companies. They need the economic activity that comes from foreign companies. And they're going to have to make a choice in how they manage this set of obstacles, which some are formal in the form of laws and some are informal in the form of bureaucratic complexity. Both matter a great deal as businesses are trying to get a foothold.
You mentioned in your remarks the bilateral investment treaty that is now being negotiated between the United States and China will be an important barometer of identifying what the intentions are of the Chinese leadership. Why is that? Why is the bilateral investment treaty so important in terms of demonstrating that intent? And bring us up to date on how far the United States and China are on that issue, and specifically how good is the negative list that they have shared with you thus far in terms of being satisfactory?
Well, first of all, the size of a bilateral investment treaty is enormous. I mean, you just look at the number of business lines. In the information technology agreement, it's a tremendously important sector. It's dozens of lines, 50 or so lines. It's hundreds in the bilateral investment treaty. So it's really a much, much larger swath of the economy. I think when China made the decision to reverse its basic orientation, where its markets were closed unless they opened them, to we're open unless we close them, that was an enormously important directional change. But if the negative list defines most of the economy, the end result is not all that different. Up until this last round, the negative lists that we've seen have not been sufficiently ambitious to open enough of the economy for the BIT to have a successful path forward. I must say in the last 24 hours, we've engaged, and I have not seen a complete analysis, so I don't want to comment on something that is very much a work in progress. But they certainly led us to expect a list that would be the basis for working together going forward, even though it wouldn't be the final end result. I hope that that's the case when our experts go through the list and report back, but the jury is out because it's literally happening in real time.
What's the sort of timetable here? When do you hope to have an agreement?
Well, my timetable on most things is measured about 7 months right now. And I have encouraged my Chinese counterparts to take advantage of the 7 months that we have. I think Secretary Kerry has done the same thing. Ambassador Froman has done the same thing. We see a real advantage to making progress. I think they want to make progress. And I can't speak beyond the next 7 months. I do know that there's a leaders meeting in China in September, and leaders meetings are very useful deadlines to focus attention. And we have said between now and the leaders meeting is a window that we should use to see if there's a possibility of making progress here. I can't sit here and warrant that it will be successful. But I can tell you it's very much in China's interest to make progress. And I think it's in the interest of the U.S. Business community for there to be a good, ambitious agreement. I don't think we have any interest in an agreement for the sake of an agreement. So it would either be a good, ambitious agreement or it will not happen.
There's another deadline at the end of this year. When China joined the World Trade Organization, it was as a non-market economy, which basically meant that it was much easier for its trading partners to bring anti-dumping and other trade actions against it. Under the terms of accession, as I understand it, they revert to market economy status at the end of this year, and those things become a little tougher. Can you tell us whether, in the administration's view, China deserves to be treated as a market economy, and what's the process by which that happens? Does it happen automatically? Or does the United States have to affirmatively approve it?
Greg, it's not automatic. It's a review that the Department of Commerce conducts to determine whether the change in status should occur. And what I have said to my counterparts in China is that the farther you go on implementing the reform agenda, the more likely you are to succeed. I will defer to the Commerce Department on the analysis that goes into making a determination.
Fair enough. Can we just turn briefly away from China? Another big issue on your plate right now is Puerto Rico. Obviously, the House has passed a bill that the administration is quite pleased with in terms of creating a control board to restructure Puerto Rico's debts. But there's an issue that I don't think has been fully addressed. Even if this control board goes into effect on July 1st, the period of August-November is one where Puerto Rico is a negative cash flow position. And we are not aware that the control board mechanism contains a way for Puerto Rico to access financing to tide it over in that period of time. There's no debtor in possession mechanism that we're aware of. Is Puerto Rico facing a liquidity crunch in that period, and what do you do about it?
Well, Greg, I think it's very important that the House passed a bill last week by a very substantial vote. 297 members of the House voted for the legislation that will give Puerto Rico the ability to restructure its debt, will create an oversight board to put Puerto Rico on a stable financial path. One of the provisions is that there's a stay on litigation. It will give Puerto Rico a breathing space to work with the oversight board to put a financial plan in place. And I think that if this legislation is passed, the cash flow crisis will be deferred, but there will be a period of time to put together a financial plan that works. I think that
will that financial plan include some kind of debtor in possession type of financing?
Well, if there's a stay on litigation, it gives Puerto Rico a bit of a moratorium where it can't be sued, so that there's time for the financial plan to go into effect. I think that there are revenues coming into Puerto Rico. There's not sufficient revenues to pay all of their bills. Okay. And on July 1, they have an enormous bond payment that comes due, $2 billion. Okay. They don't have $2 billion to pay on July 1. The question is how much they default, not whether they default. And it's a series of ongoing defaults. One of the points that I've made is I've made the case, and I must say on the flight to China and on the flight from China, I was on the telephone with members of Congress and opinion leaders on the Puerto Rico issue. It's been on my mind constantly for the last year and a half. And now it is a critical moment. The case that I make is this is not a crisis about the future. It's a crisis of the present. Right now, today, I was in Puerto Rico a month ago. You go to the main trauma hospital in San Juan. You go to the neonatal unit with these babies that are 2 pounds and 5 pounds. And these doctors who are dedicated to saving and keeping these babies healthy say they can't order the dialysis fluids except on a daily basis, wire transfers, 1 day at a time, COD. You can't run a hospital that way. It's a crisis in life in Puerto Rico today. You add defaults in a major amount on July 1, all of these problems get worse. While we were traveling, the only air ambulance service in Puerto Rico shut down because it had no credit. This has to pass. There's no other way for Puerto Rico to have a lifeline. There are things about this bill that I would have done differently. There are things about this bill that others, Republicans, would have done differently. But it is a compromise that works. It is a solid restructuring bill. It will get Puerto Rico the time it needs to get back on its feet. And there's no alternative. So I strongly urge people to pay attention to it and not to treat it as a foregone conclusion, because there's some who argue, oh, you could write a better bill, you could fix this or you could fix that. I don't believe there is a second chance. I think this is the only chance to save Puerto Rico.
Thank you. I'd like to turn to the audience now and bring some questions, some of them into the conversation. I'm going to start with Derek Scissors over there from the American Enterprise Institute. If you would like to ask a question, please raise your hand. We'll get a microphone to you. And please begin by stating your name and your affiliation.
Derek Scissors, AEI. Mr. Secretary, I'm going to ask something dangerous. I'm going to ask the Treasury Secretary to speculate. You started with the idea, as been true for 40 years, that the U.S.-China economic relationship is growing. Actually, now it's probably not. Trade volume, bilateral trade volume is shrinking year on year. As you noted, U.S. investment in China is struggling. It's kind of new investment, fresh investment is somewhat trivial. China's investment in the U.S. is growing rapidly. But as a whole, the economic relationship currently is not really growing. That could be temporary, but you noted and touched on China's very serious challenges. I wonder if you could speculate a little bit about how U.S. policy approach changes if we don't have the last 40 years of a growing U.S.-China relationship in economics. We actually have a shrinking or stagnant U.S.-China relationship in economics.
I think that if you look at the global economy, the point you just made is true for most bilateral trade relationships in the world, and it's why we have focused so much on the need globally to grow demand in the world. If you're competing over a pie that is not growing, it's not going to lead to very attractive outcomes, and it unfortunately leads some to look at beggar thy neighbor approaches to get a bigger piece of a shrinking pie. I think the U.S.-China relationship, the reason I go back to 2009 is you have to look at more than just a snapshot. Clearly, through the economic crisis, China grew faster than other economies. During that period, U.S.-China trade flows increased. I think as China settles in to a more sustainable growth rate, the volumes won't go up the way they did when they were in double-digit growth. So we have to benchmark what a growing U.S.-China relationship is around what the global economy is doing and what the size and growth of our two respective economies is. I do think that the concerns I raised about the business environment are significant. I think that it is certainly possible to find companies that still see very attractive markets in China. I've talked to CEOs in recent days about that. But it's very easy to find others in medium-sized businesses in particular, but also large companies that don't already have an established foothold that are asking, is it worth the upfront investment? And I think that the answer, macroeconomic conditions will evolve and trade flows will follow macroeconomic developments. But if those relationships start to weaken, if you don't develop the new relationships, that's where I worry about the long term not being as strong as the past. And frankly, I think that's something China should be concerned about from its own perspective, because they aspire to have an innovation-driven economy, but they have really benefited from their exposure to international trade and U.S. trade in particular to get access to the kinds of goods and services that have helped their economy grow. We have quibbled with them, more than quibbled. We've argued with them about protecting intellectual property, because one of the ways for them to grow an innovation economy is to create an environment where intellectual property is truly protected. So the progress they make there is important as well. So I don't think that one ought to look at a snapshot of the moment. One has to look at a bit of an arc of time. And certainly since 2009, it's remained very positive. I think the future, as in so many things, is dependent on policy. It's dependent on how the environment evolves and what actions the government of China takes.
This woman over here, can you bring the microphone to her? And remember, please state your name and affiliation.
Rita Chen from Central News Agency, Taiwan. Thank you, Secretary, for your comprehensive speech. I wonder, do you really believe that China will follow the commitment they made? What's the U.S. strategy, and how will U.S. react if the China play the rule? Thank you.
I didn't hear the very last piece. I'm sorry.
How will U.S. react, and what's U.S. strategy if China play the international rule?
I'm always reluctant to speculate how political leadership in any country will act. It's hard enough in our own country to make that prediction. What I can tell you is, based on my conversations with all of China's top leaders, their top economic leaders and their top political leaders, I hear no ambiguity in their understanding of the need for the economic reforms to be implemented. That starts at the very top, and it goes through every level of economic leadership. What I have not gotten a firm sense of is timetable. And I have made the case, as strongly as I can, that in the 3.5 years that I've been in this role, I've engaged with China in other roles, but this has been my principal economic engagement. I have seen the opportunity for these reforms to be implemented sort of shrink in terms of the length of the runway. They've used the time for the third plenum. They've used the time to put a lot of policies in place. They now have to execute. If they wait too long, the question is, do they wait beyond the window that they have the time to implement the reforms? the nature of these reforms is that they take time. If you look back to the 1990s, it was a 5-10 year period that reforms were implemented over. It was not overnight. You look at our own economy, restructuring in industries takes years. It doesn't take days. So I think the next 2 years are a significant period of time. We've put out a call. You need to use this time to implement what you've committed to. The balance between domestic stability, economic opportunity for individuals, and other concerns obviously weighs against the timing decision for putting tough reforms in place. If the decision is to defer them, they have a serious risk of what the medium and long-term economic future look like. So I think the stakes are very high. I could tell you my hope. My hope is that they take the advice and they move quickly. And I certainly do not question that they understand the need to do that. What I can't answer is how the political balance is weighed.
Thank you. Right here.
Mr. Secretary, Barry Wood, RTHK in Hong Kong. I'd like to ask you about exchange rates. What did the Chinese agree to at the Shanghai G20 finance ministers meeting in February? And coming to the G20 finance ministers meeting in Sendai, was the reason that you were so harsh against Mr. Azo about the yen that you're concerned that if the yen goes down, that the Chinese would feel that they could allow the renminbi to go down?
I think that the Shanghai G20 was actually a very important moment in a number of ways. If you think back to what the kind of global environment was, the psychology was, it was very negative. There was a fear of substantial government policy that would destabilize both exchange rates and economic stability. There was concern that we could end up in a cycle of competitive devaluation that's very damaging. Interestingly, with its presidency of the G20, China was with the United States in promoting language that would strengthen the commitment to refrain from competitive devaluation, and it was with the United States in supporting language that called for more communication so there would be no surprises. They also were allies in promoting macroeconomic principles that called on governments to use all policy levers, monetary, fiscal, and structural, to create stronger growth. I think that is something which if you had 5 years ago or 10 years ago suggested would happen, people probably would have laughed at you. And it was in fact the case. I think that the questions are not limited to one country. I think that in a world that is growing too slowly because demand is too slow, if the way countries respond is to compete for that shrinking pie by having beggar thy neighbor policies, there's always a risk of response and escalation, which we've seen does not lead anywhere good in terms of global growth, and it's led to very bad places in the past. I think it was very important that the Shanghai G20 stabilized the mood in international markets for at least the period between then and the period right after. It was not a moment of economic crisis. It was a moment of economic anxiety. And if Shanghai had produced discord on these issues, I'm not sure what the global economic environment would have looked like, but I don't think it would have been a pretty picture. If we had treated it like an economic crisis, like the financial crisis, there wasn't the basis for that. That's not where the real indicators of the economy were. And we're also not in a world where all economies are facing the same economic challenges or have access to the same mix of economic levers. So there's not a one-size-fits-all outcome that one could have aspired to. I actually think Shanghai was a quite successful G20, and it underscores the importance of having these kinds of conversations so that you don't end up seeing the kinds of surprise actions that lead to consequences that are very difficult to manage.
Thanks very much, Mr. Secretary. We're almost out of time, but I would like to take the moderator's prerogative of asking the last question. Next Thursday, the British will go to the polls to vote on whether to leave the European Union, which they joined more than 40 years ago. If they vote to leave, what are the consequences, both the short and the long term, not so much for Britain, but for the global economy as a whole?
So, Greg, I've made very clear that I see as an economic matter a very strong case for the UK to remain in the European Union. There's a decision for the people of the UK to make. The special relationship between the US and the UK will exist whatever the outcome of the election, of the referendum. But I think the idea of putting walls back up and creating friction in Europe's economy, even within the UK potentially, is something that only leads to negative economic outcomes. I don't see the pathway for positive economic outcomes. I also see a Europe that has been, slow to regain any kind of significant growth. It's not a great time for that to be undermined. And the global economy, as I said a few minutes ago, is not growing at a rate that is satisfactory to produce the kinds of opportunity that we and the rest of the world want. The U.S., with our growth rate that we would like very much to drive higher, is seen as one of the bright spots in the world because we came out of the financial crisis with sustained growth, job growth, lower unemployment, and healthy consumer demand. I think political decisions, and referendum is it's not a legislative decision, but it's a policy decision that work against that are consequential. The outcome is obviously up to the people of the UK. We will work with the UK and the EU regardless of the outcome. But I think I've been clear. I see only positive economic arguments for remaining and negative ones for leaving.
Mr. Secretary, thanks very much for coming and sharing these thoughts and insights with us.
Thank you, Greg.